Today's event, we're talking about Africa's regional economic outlook, restarting the growth engine. The IMF's recent biannual report on the economic outlook for Africa. And we're delighted to be hosting Mr. Abebe Selassie, Director of the IMF Africa team, to kind of lay out the report. He'll make his presentation and then we'll turn for interactive question and answer. Mr. Abebe has had a 22-year career with the IMF, serving in senior management as well as a residential representative in Uganda, mission director for South Africa, and a number of other positions elsewhere in the world. So we're delighted to host him today for this. 2016 was not a great year for African economies. I was looking back at some of these regional reports, the subtitle, this one is Restarting the Growth Engine. And you see, look back and it's kind of keeping the pace, sustaining the momentum, accelerating growth, and it start navigating the headwinds, gathering storm clouds. 2016 was not great, a commodity slump, drought in much of southern Africa, insecurity in other parts. Things are likely to pick up according to the report, and commodity prices are coming back, but that's not the kind of end of the story. And I think one of the challenges, but all the strengths of these reports is they try to veer away somewhat, despite the titles, from kind of simplistic narratives about Africa, it's rising, it's falling, and get at some of the divergent trends that are happening within commodity dependent countries, non-commodity dependent countries, good performers and less good performers. And even for some of the good performance of this report, some of the cautions going forward that they will need to sustain growth. These reports were released in April. They're online. I encourage you to read them. Particularly interesting to me was the section on kind of the informal economy and how do you harness the strengths of the informal economy while kind of mitigating some of the uncertainties around that. But we'll get into discussion after the presentation. And Mr. Selassie, welcome and thank you for joining us today. You can come up. I will come down.
Thank you.
Great, thanks.
Jennifer, thank you very much. A very good morning to you all. It's very good to be here. And I hope you'll bear with me while I go through some PowerPoint presentations. We at the IMF always need some kind of a crutch. So I hope you'll bear with me. But I'll try and keep it short and as much as I can. So I just want to start by making a couple of points. The first one is, I think, as Jennifer very nicely said in her introduction, that I'm always a bit hesitant in doing presentations like this, and like to make the point that Sub-Saharan Africa, in particular, the region I'll be talking about in a moment, is incredibly diverse, incredibly heterogeneous region. And the circumstances that prevail, while we try and be as nuanced as possible, we don't do enough justice to it. We have to really be careful about when we talk about Sub-Saharan Africa to not think of it as a single block, and that in each country and over time circumstances change. So I just want to note there's tremendous heterogeneity, and I'm not going to be doing enough justice to that. The second point I want to touch on also is that we tend to have a very simplistic prism through which we look at Sub-Saharan Africa. As Jennifer was saying, is Africa rising, Africa not rising, or Africa falling? It's always very 2-3 word frames that we use. And a lot of hyperbole associated with that also. And again, reflecting the diversity of circumstances, but also that this is a region where there's been so much change over the last 20-25 years, tremendous positive change, that we don't do it justice when we use these very simplistic phrases to try and capture what's going on in the region. Having said that, I hope I live up to these caveats and bring enough nuance to my presentation. In particular, this is a very somewhat streamlined version of a very rich report that Jennifer mentioned. It's called the Regional Economic Outlook for Sub-Saharan Africa. My presentation today will have 4 brief sections. I'll start talking about the broad trends in economic growth that we see, which is what's given rise to this idea that the bottom has fallen out of the economic picture in Sub-Saharan Africa. I will then talk about what we've seen by way of policy response by countries. Third, I will talk about what we see as the challenges in many countries, again, with a large focus on the macroeconomic side. Then lastly, I will talk about what kind of policy recalibration is needed to get growth going again. So, starting with the growth picture. The last 10, 15 years, actually since the late 1990s, have been a period where growth in the vast majority of sub-Saharan African countries have been very strong. In general, growth has averaged at around 5.5% for the region as a whole, with some countries growing at considerably faster pace. This is what gave rise to this phrase of Africa rising, reflecting the very strong growth performance in the vast majority of countries. This particular chart shows the growth breakdown in the latter period of this long period, between 2010 and 2015, and basically shows that most countries' growth was clustered around the 5% mark. The red boxes represent countries which rely on commodity exports, and the blue boxes countries with much more diversified commodity exports. And what you see basically is that growth, this histogram basically shows the growth clustering around the 5% mark. So very healthy growth rates. What happened in 2016, of course, was that growth decelerated, particularly acutely so in commodity exporters. So you see more of the red box countries in recession or at zero growth and the like. But even in 2016, when growth was fairly weak for the region as a whole, you still, again, bringing out this point about the diversity of circumstances, you still have quite a few countries continuing to grow fairly rapidly. So the likes of Cote d'Ivoire, Tanzania, Ethiopia, Senegal continue to grow at 6% or more. And the median growth rate for the region itself was around 3.7%, so fairly high. The regional average, however, was only, growth for the regional average was only about 1.4. And that in large part reflects the impact of some of the largest economies in the region, which tend to be commodity exporters, and the fact that they had been hit very hard. In particular, South Africa, Angola, and Nigeria were either in recession or saw very little to no growth. Basically bringing the regional average growth number down to around the 1.5 mark. So in a nutshell, and to the, again with the caveats I laid out at the beginning of the presentation, to the extent that we can have a simple way of explaining the growth outcomes. We had a year where commodity exporters were being hit very hard and experienced really poor growth, but most of the diversified economies in the region continuing to grow at a fairly healthy clip. Of course, there was more than just the impact of commodity prices going on in the region. In particular, we had food insecurity issues in quite a few countries, and even outright famine in places like South Sudan over the last 6-9 months. By and large, these humanitarian problems have been in areas which have been either in conflict or just emerging from conflict, or where security situations has been very challenging. So the Sahel belt, and of course acutely so around the Lake Chad basin, and of course South Sudan and Somalia, where security conditions are extremely difficult. So those have given rise, of course, to humanitarian crises, and I just don't want to lose sight of that. So, in a way, kind of 2016 was a difficult year for the region. 1.5% growth is the worst growth outcome, going back at least to the early 1990s. So in the face of this slump, what has the policy reaction been? Guys, I'll lay out the broad trends that we've been seeing. So when growth slows down and commodity prices have fallen, so external revenues have been impacted, of course. One of the things we saw basically was, one of the areas we focused on was, of course, on the fiscal accounts, what's been happening to the fiscal policy response of countries. For this particular block of work, what we looked at was we created 3 analytical groups. Oil exporters, where the evolution is represented in the leftmost chart. In the middle panel, we look at non-oil commodity exporters, so countries that have either copper or metal exports and still commodity-reliant countries. And then in the last block, we look at countries with more diversified export structures. What I want to highlight is 2 things. One is that in the oil exporters, of course, what we saw was basically with the decline in oil prices, larger deficits emerging almost automatically. Oil revenues have declined, so there's less revenue coming in, and spending continued in the same vein. In fact, it was reduced, but despite that, fiscal deficits widened. So this is a classical counter-cyclical Keynesian response that you would expect to see. On the right block, the countries that are, with more diversified exports, what's striking was that they too saw a widening of their fiscal deficits. Fiscal deficits in those countries were around the 4% mark, but widened to around 5.5% also. So, I have basically the same dots here and superimposed the growth outcomes in the 2 regions. In the 2 grouping of countries. So as you can see, to some extent, the policy response in the oil exporters was understandable, as I noted, because there was a collapse in growth and incomes. But what's striking is that in the countries that continue to grow fast, they too have seen a widening of the fiscal deficits. To some extent, this is understandable. Most of these countries, these are the likes of Kenya, Tanzania, fast-growing countries I cited earlier. To some extent, they're all trying to invest a lot in health, education, infrastructure. The problem, however, is, of course, that if you're adding to debt, if you're running very large fiscal deficits, even when you're growing rapidly, then of course you're making yourself vulnerable. So the policy response in this group of fast-growing countries has not been the ideal response either. The challenge for the oil exporting countries is that while some widening in the deficit is appropriate, they yet have to put in place structural measures to offset the loss in revenue from oil, and as a result, there's some uncertainty that has crept in and is deterring investment. I'll come to talk a little bit more about this in a second. On the external side, one of the other policy responses that we've seen, maybe a couple of charts quickly on that. One is, of course, with the decline in oil prices and the oil revenue, other commodity revenues, but more generally, sentiment towards frontier markets and emerging markets, at least last year, having weakened. What we saw was significant exchange rate depreciations across the board. The bars basically show the extent to which exchange rates had weakened from where they were at the beginning of 2014, and in some cases you've seen very significant depreciations, of the order of 50-60% depreciations. What's worrisome was that even that wasn't sufficient to address some of the pressures on the external accounts in some countries. So in the likes of Angola and Nigeria, but also other countries like Ethiopia and Burundi, what we saw was a widening of parallel market rates emerging and a black market premium emerging. So some activity and some transactions were going off the formal sector. Again, a sign of policy response not having been adequate, and that there's still unmet demand for foreign exchange out there, which was being restricted. And despite the significant weakening of exchange rates, by and large in the region we saw foreign exchange reserves declining. Basically the gray area shows the broad trend for the, between the 25th and 75th percent range for of movement in the foreign exchange levels. And of course, the oil exporting countries, which is the red line, the decline there was even more acute. So they've seen a very sharp decline in direct foreign exchange reserve levels. In a nutshell, we saw basically policy response, which was, I think, if there's one word that I can use, that was insufficient to the size of the shock, to the size of the macroeconomic problems that had emerged in the wake of the decline in commodity prices. And so, what have been the implications of this insufficient policy response, and of course, first and foremost, the shock itself? One of these has been, of course, an increase in debt levels. I want to be very clear that this increase has been, again, as always, been quite varied. The extent to which the level of debt has increased is quite varied, but also that it's increasing in most cases from a very low level. So in the wake of the very rapid growth that we saw in the region, some debt relief that countries got in the mid-2000s, what we saw was the average level of debt in the region declining to around the 40% mark. Much more so in oil exporters who had a lot of oil revenues and were less reliant on debt financing. But over the last 4 or 5 years, what we've seen is a trend increase in the level of debt. So this has been one of the trends that we've seen as a result of the lower growth and wider fiscal deficits that I noted earlier. Again, to come back and unpack a little bit what's been behind this debt increase, we again broke down the 45 countries in Sub-Saharan Africa into 3 groupings, the same groupings that I showed earlier. And this time the dots show the percentage point increase in debt between 2011-13 and the most recent data available, average for 14-16. And almost across the board we saw debt levels increasing. And the 2 factors that have contributed to this debt level, as I showed earlier with the fiscal deficits, also is in the first instance the fiscal deficits. So we're looking here, the bars show the contribution of the extent to which fiscal deficits contributed to the increase in debt. And the other important factor has been the weaker exchange rates, which is shown here in the blue bars. So, particularly in the oil exporting countries, which is the panel on the far left, you see how big a contribution that the exchange rate depreciation made. The green bars, which are more relevant for the box on the far right, on the block on the far right, they show basically that in the fast-growing countries, high growth has, of course, had the tendency to offset some of the increase in debt caused by wider fiscal deficits and exchange rate depreciation. Again, I show these charts again to show the fact that the increase in debt is not automatic, and that it's the policy response, it's the policy behavior that's contributing to this as much as it's lower growth and exogenous factors. One of the effects, and something which is a bit worrisome, particularly in the commodity exporting countries, of course, is that although they have very low levels of debt still, in terms of debt servicing, we're seeing emerging pressures. And these charts basically show the debt service to export ratio and the debt service to fiscal revenue. And in both cases, for the oil exporters, which is represented by the blue bar, you see a very, very sharp increase. So again, unless this is addressed very quickly, it's going to lead to debt servicing problems in the oil exporting countries. And this is something we're working with countries. looking forward a little bit more, so after the slump in growth to 1.4%, we are expecting a recovery in growth to around 2.7% this year and on to around 3% next year, and a bit more still beyond. This still is, considerably weaker growth rates than we've seen in the recent past, and reflects to a large extent the fact that there has been insufficient policy adjustment I noted earlier, and the fact that 2-3 years after the collapse in commodity prices, particularly in the oil exporting countries, but also in several other countries, there remain fairly large imbalances which are holding back confidence and retarding private investment because of the uncertainty on the direction of policies. So if you'll bear with me a few more slides to wrap up and what we think are the policy refinements and adjustments that are needed. I think before I go into discussing what the appropriate policy response is, I think it's important to stop and consider what the factors behind the improvement in growth outcomes in the region have been over the last 15, 20 years. To our way of looking at it, I think there are three broad sets of factors that have contributed to the very strong growth outcomes. And one thing I should add also is that this period of high growth in Sub-Saharan Africa has not just been about growth, but it's been accompanied by improvements in human development outcomes. So we've seen significant declines in really important measures, for me at least, of well-being, things like infant mortality, maternal mortality, human development index, school enrollment ratios, all of the MDG goals, some of which have been picked up in the Sustainable Development Goals. Most of those indicators have improved. By no means across the board in terms of the indicators or across all countries, but there's been significant improvement in those important dimensions, non-income dimensions of well-being also. So, this period of high growth, in our view, has been underpinned by three sets of factors. First and foremost has been improvement in institutions and macroeconomic policies. When I mean institutions, I speak of course, the wave of democratic elections that we started seeing in the region from the early 90s, which allowed for more constrained governments, more constrained executives to be in place, a lot more checks and balances on governments. So that political side has been very important. On the economic policy side also, there's been a sea change in the way macroeconomic policy has been conducted. Central banks have been pursuing important reforms. Fiscal policy has been generally in a very healthy clip, pursued in a healthy way in the vast majority of countries. So that has been a very important anchor for policies. But it's been supplemented by two external factors. One has been, significant external capital flows to the region. Partly pull factors, as conditions on the ground have improved, capital has been attracted to the region. So we've seen a lot of foreign direct investment, but also faster moving portfolio flows moving to the region significantly. So there's been a pull factor, but there's also been a push factor. So as external conditions, the global liquidity glut that we've seen just in the run-up to the global financial crisis and in the wake of the global financial crisis, as monetary policy has been eased in most advanced countries, has also been pushing a lot of capital to the region. So capital flows have been important. And for the countries that are commodity exporters, high commodity prices have played a very supportive role in terms of the growth outcomes that we've seen. There's a very simplistic view often out there that, Africa growth is all about commodity prices, but this is, of course, not the case. If you're Nigeria or if you're Zambia, copper prices go up or oil prices go up for Nigeria, of course it will be beneficial. But we shouldn't forget that, if you're, say, Kenya, you have to import oil. High commodity prices actually are detrimental to your economic well-being. So the fact that you have a lot of, two-thirds of the countries in the region don't have any significant reliance on commodity exports. So the fact that those countries have sustained high growth despite high commodity prices actually is a sign of how much, despite significant headwinds, growth outcomes have been strong. So in a nutshell, these three factors have underpinned growth. And what we're seeing now basically is the one important factor, this high commodity prices in particular, having weakened and thus affecting the countries that rely on commodity prices. In terms of what kind of policy dialogue we're having with countries, what kind of policy reforms are needed, again, with a nod to the importance of policies being country specific and even within countries time specific. I just want to highlight a few trends or a few areas that are going to be important. The first one I think is that I think there's a need to bring back macro stability concerns back on the front burner in the vast majority of countries. As I noted earlier, in the oil exporting countries and a few other high commodity exporting countries, very large imbalances which are deterring significant private investment from taking off, despite in the wake of the commodity price decline. So it's very urgent need there in those countries to find alternative ways for paying for the many goods and services that they need to provide. Strong adjustment is going to be needed in many of those countries. In the countries with more diversified exports and that are continuing to grow rapidly, here too, as I noted earlier, fiscal policy is pro-cyclical, is still on an aggressive footing, leading to mounting debt. And these countries, we're urging from the position of strength that they're at right now to begin reducing the fiscal deficits to contain to strike a better balance between investment and the debt build-up, because we feel that the balance is a little out of whack. As they say, the time to fix the roof is when the sun is shining, and in those countries it's really important that they do the adjustment now rather than wait when they've been hit by an adverse shock, which will make things difficult. So, macroeconomic policy recalibration is needed in the lion's share of countries in the region. Second issue is that we need a lot of reforms, structural fiscal reforms in particular, to support healthier macroeconomic outcomes. I want to highlight two reforms in particular. First is domestic revenue mobilization. This is very, very important, particularly for the oil exporting countries, but also for the countries that continue to grow rapidly. For commodity exporters, they need to find a new tax handle, a new revenue handle, and finding new taxes, expanding existing taxes, broadening the base for expanding taxes is going to be a very important objective, and one of the best ways to try and reduce the large fiscal deficits that they face. In the countries that are growing rapidly, I mean, it's a little bit less, it's a bit more about, the reason why fiscal deficits are high in those countries is because they're investing a lot in infrastructure in particular. And, one of the seminal developmental challenges has always been how to capture the rate of return on investment. And this is the time to really begin to collect more revenues and recoup the returns for the investment that they've been doing over the last many years. Another important reform is going to be, better prioritization of public investment projects. When resources were ample, particularly in the commodity exporting countries, we saw, a plethora of public investment projects being initiated. But with resources significantly constrained, it's going to be important to look again at, which are the projects which have the highest rate of returns. And we do quite a bit of work to try and prioritize projects, try and make sure that, projects that are close to being completed are not abandoned in a bad way. But again, spending prioritization is going to be very important, particularly on the public investment side. So, structural reforms to support macro stability, again, are going have some prominence in our dialogue. Last but not least, is with the decline in growth, with the deceleration in growth, and of course with the loss in incomes that countries have been suffering, of course, there's a strong risk that poverty will begin to go up. There's going to be, risk that people will be losing their jobs. So it's, we're emphasizing and doing quite a bit of work to try and find ways of making sure that the policies that are being adopted are sensitive to and address these vulnerabilities or risks. So, not only do we look at the calibration of policies to make sure that they don't have too adverse an effect on poverty levels and the like, but also we're asking countries to see if there are ways in which they can introduce new social protection programs, if they don't have, where they have some already, to try and expand those, to try and mitigate the adverse effect that this period of low growth is going to have, could have on poverty and human development outcome indicators. Last but not least, I just want to emphasize that when we look at the outlook for Sub-Saharan Africa beyond the near term, we remain very, very bullish, very optimistic. I think, again, one reason for this is looking at the progress over the last 20 years. Anybody who was in the region in the early 90s or early to mid 90s and goes back now, the change is just incredible. And I don't mean just, the buildings that we see or the roads, nice roads that we see in some capitals, but really, in areas, which are rural areas also. There's been significant transformation. By no means has this been even. It varies from country to country, and there are countries which remain mired in conflict and in very difficult circumstances, of course. But there's been very, very important progress, as I noted earlier. But looking forward, there are important dynamics also which will support very strong growth. It's not a given. It will require a lot of investment, a lot of policies that are appropriate being pursued in the coming years. But I just want to highlight one important factor which we think shows the kind of potential the region has. Sub-Saharan Africa is going through a demographic transition, the like of which the region certainly has not seen. And it comes and is going to be happening at the same time that much of the rest of the world, much of the rest of the world's population is aging very rapidly. So just this chart basically shows the evolution of working age population in the rest of the world and Sub-Saharan Africa. The red bars represent Sub-Saharan Africa and the green bars show the rest of the world. By 2030, a short, 12 and a half years from now, half of the increase in the working age population globally will be coming from Sub-Saharan Africa. By 2050, Sub-Saharan Africa will be the only source of increase in the global working age population. We've been arguing for a while now that this has tremendous potential for the region. Not least, my sense is that global economy is going to need Sub-Saharan Africa's labor force to do any significant scale activity going forward. So I think something that has to move up the policy agenda, and I think we're increasingly seeing that, is how to integrate Sub-Saharan Africa's labor force into global supply chains. Frankly, I can't think of a company of any significant size going forward that has any significant operations that is not going to have a presence in Sub-Saharan Africa, given that is where the global labor force is going to be. So, again, very strong, important drivers of growth and better outcomes going forward. I'll end my presentation here. Thank you very much. Stay here.
Oh, I'll sit over there. Great, thank you so much for a big overview done in a very compressed time. It's funny that you mentioned, the time to fix the roof is when the sun is shining. I was actually just before that thinking of, there's an old American folk song, The Arkansas Traveler, and he's traveling through Arkansas. A man is fiddling on his roof while the rain pours through his house, and he says, "Why don't you fix it?" And he says, "I can't fix it, it's raining." And he says, "Well, why don't you fix it when the sun is shining?" And he says, "When it's shining, I don't need to fix it." So one of the great hopes for this commodity slump was that it would kind of prompt the kind of hard reforms needed. And it sounds like places like Nigeria that have huge opportunities to kind of in domestic resource mobilization, and that actually, for example, have diversified economically, but it didn't prompt the kind of reforms that maybe many were hoping for. And I wonder too, though, if it also, I mean, the great hope was that with a number of new energy producers coming on board, do they look at that slump and then start to plan a little more strategically their own kind of energy sectors and fiscal policies and so forth?
Yeah, so fairly good points. I think, if we take Nigeria, for example, I think, all credit to them. They have done some important institutional reforms. I mean, I think the focus on corruption, in particular, I think has been a really important one. And, in the long run, something that will help strengthen institutions. I think that's important. On the macro policy side, I think perhaps reflecting really the depth of the challenge. There's been some hesitancy in how to go about addressing the macro challenges that they've been facing. The good part for them is that debt level is low, so there is scope for them to borrow and do more financing than adjustment in the near term, at least on the fiscal side. But of course, if you don't begin the process of putting in place new forms of revenue or looking at the way state governments are financed and what kind of tax handles they can do, you're losing time. So it's more in that vein that we're discussing in Nigeria. That while debt is low, use again in a way a bit of an analogy with when to do reforms and the point you were saying earlier. So I think we're stressing that time to do so is now. Now there are other countries in the region which are oil exporters which have actually close to run out of time. I mean, I think in those countries it's much more urgent to do reforms, and we are, after some hesitancy, seeing that beginning to happen, including some we are beginning to support. So a mixed picture, I would say.
From some of the good performers that are, that have been high growth but also high public expenditures, Senegal or Cote d'Ivoire or Ethiopia, I imagine falls into that. I mean, is there kind of growing recognition? Are you pushing kind of against kind of closed ears when you say, look, you're going to have to balance things out here? I mean,
I think particularly in the last year or so, I think much more increased recognition of the need to moderate fiscal deficits at this time of high growth. So just to cite, for example, Senegal and Cote d'Ivoire, they're both members of the Western African Monetary Union, and they all have targets to convergence criteria to reduce their deficits by 2019 and are sticking to them and are beginning to work their way down. Of course, it's not always straightforward. Cote d'Ivoire, for example, this year has been hit by a decline in commodity prices, cocoa prices. So they've had to widen the fiscal deficit temporarily, but more and more we have, the dialogue is about how to anchor, how to find an anchor for fiscal policy and get the deficits down. Again, I have a lot of empathy also for, the factors behind the wider fiscal deficits, and in many cases it is trying to address the huge developmental challenges that they have, investment in schools, education, of course, also infrastructure. But where countries are perhaps not doing enough is in mobilizing revenues. So one way, and this is why we're stressing domestic revenue mobilization, they can continue to spend the spending levels that they have, but only if they also increase revenues more and help basically pay for this without having to resort to borrowing.
Right. So something our own country is dealing with, that striking that correct balance right now. I guess every country does. Let's take a few questions together. I have a few more that I will ask. Tony, why don't we start with you? And Mike will be coming. Introduce yourself.
Hi, Tony Carroll, formerly a senior associate at CSIS.
Still a CSIS friend.
Thank you very much. Wondering on the role of capital inflows, which you note as part of the story of success in Africa. I'm wondering if we've ever been able to distinguish the capital flows source of capital flows. And the point that I'm trying to maybe extract from your presentation is the durability of flows coming in from abroad versus flows that originate from within the economies. And the warring vision that I'm trying to reconcile in my mind is whether or not there's more durability in economic growth when that growth comes from indigenous, organic, bottom-up growth, or whether it comes from externally led, statist sort of driven foreign investment. And I think you know where I'm going with this, being from where you are. I'm just sort of wondering, have you reflected, or has Dr. Allard or any of your very capable colleagues have been mined down in terms of seeing whether the stories are different between the organic, homegrown, indigenous growth from savings versus the externally driven growth? And maybe there's no reconciliation. Maybe the economic conditions of these countries are so different that you can't extrapolate. Tough question, I think, huh? That's the 301, maybe the 401 question in school.
Oops.
So, yeah, interesting question. So first part of your question on what the source of the capital flows has been. I think it varies from country to country. But, for me, well, first of all, kind of, just to the best you can generalize, we have seen domestic investment also going up. So it's not just been foreign direct investment in most countries in the region. So with the better policy environment that you've had, better political environment, we've seen, domestic, internally financed investment going up. So that's always an encouraging sign, whether it's in Africa or elsewhere. Ultimately, I think growth is going to be based on domestic investment. So I think across the board, we've seen that to varying degrees. Then kind of the question is, what role does government policy or government-driven investment play? I have to say here, circumstances differ across the region. If I may draw on my own experience, having been at the IMF and worked, for many years outside Sub-Saharan Africa, in 2006, I had the first chance to go back after 10, 12 years being away from the region to the region. I went to Uganda, moved as resident representative for a few years, and Uganda is kind of a place where you have Washington consensus policies writ large. So foreign exchange markets are liberalized. They privatized almost all state-owned enterprises. But what struck me at the time was that while growth has been very robust and the private sector was fairly dynamic, growth was still at around the 6% mark. Had been for many years. In contrast, places like Rwanda, Ethiopia, where you have much more government-driven models, had perhaps less private sector investment, but a lot more infrastructure, and also growth was higher still. One conclusion I drew kind of from what I know of, say, the Ethiopian model and the Uganda or other models there is that, I think ultimately it depends on country circumstances and a whole host of factors. If you don't have the state capacity or the preferences for a more vibrant, diverse private sector-led model, I think one should do that. And if state capacity is stronger, then maybe you want to have a different type of model. Frankly, I don't know which is going to work, and I don't know that there is a single model that fits all countries in the region. So, this is actually a point of discussion. A couple of times I've been to Nigeria recently. Government has been looking across to the east and wondering whether a more state-driven model might not be appropriate in Nigeria. Given state capacity there, I'm not sure the federal government could drive that, because a lot of power has devolved to the state. So again, I think what kind of policy that you have, I think is going to differ on the country circumstances.
Yes, ma'am.
Hi, Emmy Simmons, non-resident senior advisor here at CSIS. You portrayed the demographic transition in fairly neutral terms and fairly bullish terms, as you said. This is going to be terrific, having this growing labor force. Other people, however, have described the demographic outlook as a ticking time bomb, basically because there seems to be a lack of growth in formal sector jobs, that actually build upon education and provide motivation for youth to stay in school. And the capital investments that are being made do not seem, in many cases, to be consistent with employment generation and the generation of good jobs. So I just wondered if you'd comment a little bit further on what seems to be out there as a big controversy.
Okay, so point of advertisement. We, two or 3 years ago, we actually did one of the analytical topics that we looked at in our Rio was on exactly this issue of demographic transitions across the world. And we looked at, how other countries had also, how the demographic transition had played out in other parts of the world, Latin America, Asia, Europe, Eastern Europe. And within Africa itself, I think, the stages at which countries are in the demographic transition actually varies quite a lot. So some of the Southern African countries actually are quite advanced in the demographic transition, and a place like Niger has yet to start. So again, incredibly varied picture. But a couple of takeaways from that work. One is that across the world, countries going into this demographic transition, if you look at kind of per capita income level at the beginning of a demographic transition and at the end, in almost every case, you find countries coming out richer than at the beginning of the demographic transition. And this, we found, kind of it reflects a lot of positive forces that demographic transition tends to unleash. One of the reasons why, the demographic transition basically is like a shift in the dependency ratio. And one of the
Okay, explain the dependency ratio.
Oh, sorry. Basically, the share of the working age population relative to people that are not working, either because they're older or because they're very young. And in most African countries, they're very early in the demographic transition, and the share of working age population is low because you have a lot of young kids. And of course, if you take the opposite extreme, a place like Japan, you have a lot of old people. So you have, population where the median age, which is, 40 versus 18 on average in Sub-Saharan Africa. So one of the factors that constrains, income levels, spending levels, etc., is the fact that you have, the share of the working age population relative to people that are out, not active in the labor force is higher. So I don't want to be too technical, but so there are a lot of positive factors that, moving into a situation where you have a lot more of the population and the working age population unleashes a lot of demand for goods and services. That itself creates jobs and stuff like that. But, I don't want to leave the impression that it's a given that countries will reap the dividend, this demographic dividend, and it's tremendously challenging. Not only that, but where you come out at the end of the demographic transition, whether you end up closer to Latin America, lower middle income country levels, or what happened in Asia, where we saw a huge increase in income, which coincided with countries going through demographic transition, depends a lot on policies. So exactly the kind of things that you said, investment in health, in education in particular, to make sure that you are creating workforce which is healthy and well educated is going to be very important. Frankly, this is why I also, in the positive side that I see to it is that it's happening at a time exactly when the rest of the global working age population is indeed aging. Absent technology, as we're being told, making all of us redundant and all, I think ultimately there's going to remain significant demand for, labor input in production process, and the only place that you're going to find that in significant numbers is Africa. So I think, capital will be attracted to the region before long. And we are already seeing that over the last several years. So.
It kind of leads me to a question. Maybe you can talk a little bit about the section on the informal economy and kind of what's the broad scale trend on that. I mean, it serves as nobody's exactly idle. What are the trends on that in terms of a percentage of the economy? I don't know how you measure that. Yeah. What are the policy recommendations in terms of capturing some of that? And
so again, this time one of the in our quest, what we try and do in our regional economic outlook is look at the conjuncture and the macro policy challenges, which is of course our bread and butter and our area of focus, but also look at some of the developments which are slow moving but still macro critical. And one of the chapters this time around looked at the informal sector. First and foremost, how it varies across the region, and again, touching on the question you raised also, what struck us was how, in some countries it's as low as 12-13%, places like Mauritius, for example, in the region. But you go to a place like Nigeria, and the share of the informal sector in the economy is close to 60-65%. But what was even more striking for me is that you have two countries, Togo and Benin, right next door to each other, with very differing levels of informality. So, Benin, maybe its proximity to Nigeria, you have, very significantly large, very large informal sector, and Togo, just the other side. I mean, these, much more smaller private sector. So again, situation varies across the region. Now, what's interesting is that and what's clear is that the informal sector, of course, is an important source of livelihoods, across the region, again, to varying degrees. And what we focus on is how do you allow the informal sector firms, particularly the ones that are increasing in size, how do you help them bridge to moving more into the formal sector? What are the constraints on their growth? Things like financing, for example. How do you get banks to be able to reach them? So that was the nexus of issues that we focused at, and but the striking finding for me was just how varied the size of the informal sector is, and we did some very nice work that did robustness check on the size of the sector to identify.
So it's kind of tipping some of those firms out of the informal into the formal, but then also buttressing kind of financial services and support for those kind of still
Exactly.
in the midst of it.
Yeah.
Health and education. Yes, sir. And then we'll go here and then there. Up front row. Further.
Good morning. I'm Femi Akibi, Manchester Trade. My question, just to follow up on your issue of informal economy to the formal. I'm a Nigerian. The amount of informal economy we have in Nigeria is mind-boggling, and we cannot figure a way to transfer this informal to formal. As a result, we could not take advantage of all the technological advancement or digital advantage you could seize in some of this area. I would like your opinion in how we could use technology to drive the informal to the formal, i.e. digital banking. And last question, your opinion on the issue of currency devaluation how does that affect our capital outflow and inflow? And I want you to kind of go a little bit, if you can, to the history. In 79, the exchange rate between the Naira and the dollar was 1.86. Today it's about 400 to 1. That's 8,500% backward. If we attach that to standard of living, we don't even want to think about it. So I want your opinion.
Easy questions.
Easy.
So first on the role of technology. Again, this varies the extent to which things like fintech are playing out in the region varies tremendously. But I'm continue to be just flabbergasted every time I am in places like Kenya and Rwanda, and I look at how people transact almost everything using their phones. Most recently, a governor of a central bank showed me how the M-Pesa has grown to instead of being a digital wallet, they now actually can transfer money from bank account to bank account just using your phone number, and and it's not just kind of just with an app, and it's just amazing and how much advanced some parts of technology is relative to what we have here for daily use. And a lot of it, is technology which is being spread and created in the region. So I think it's very, very important. I'm more excited still about governments beginning to adopt technology for things like collection of tax payments, screening of projects, and the like, which is beginning to happen at the margins in the region, which I think will be a very important platform for engaging with government and making the ease of doing business, paying taxes and the like much easier going forward. So I think that's also important innovation. What it does for the informality, I think, what technology does, I think is basically reduces transaction costs, which is of course very important and allows the sector to grow. We're seeing importantly now the beginning of growth of credit also. So just instead of just simple transactions in terms of using technology, but also the financial sector beginning to provide credit using these platforms. But this is still at a very young stage, and I'm not sure at a stage where it is going to be the main and only driver of the growth of the informal sector. But certainly I think technology offers a lot of promise and shows kind of the vibrancy in the region. My only hope is that you have a lot of countries also in the region where the penetration of this technology is limited, and that those countries to adopt the reforms and which will allow more inclusion. We find that women in particular, traders, marketing women, having benefiting tremendous amount from things like fintech. So at a minimum it's helping reduce transaction costs and improving living standards, but whether it's going to be the breakthrough that will allow and foster much growth, economy-wide growth, I'm not sure yet. Turning on the exchange rate, I think to some degree exchange rates reflect the overall health of the economy. But one thing that worries me is the tendency that we have to be hung up on a particular exchange rate. At the end of the day, it's a price, important price. It's one which is extremely visible, but also it has an element of the price of an asset. That's why I worry when people are fixated on the exchange rate level. I think what's important is that in the formulation of policies is of course overall you choose whatever kind of framework that you want, whether it's a flexible exchange rate regime or a fixed exchange rate regime, and then you pursue the supportive macroeconomic policies in support of that regime. What we've seen in some countries is that when there's been a lot of pressure on the exchange rate, or when you've seen a big decline in export income, there's been a tendency to resist that by means, not by fixing monetary and fiscal policy, but really by trying to force an unrealistic exchange rate. And that either pushes transactions out of the formal sector and gives rise to a lot of governance, corruption problems, or else, restricts the availability of foreign exchange to important economic sectors, and it drives economic growth lower and lower and lower. So, exchange rate, of course, is an important variable, but one which really fundamentally reflects the underlying health of the economy. And I think, the focus has to be on that above everything else.
The gentleman back there, and then we'll go Tim, and then, yeah. So let's take a couple at a time since more hands.
Okay, it's Chris O'Donnell, Development Essentials. I just wanted to ask about with famine and drought in Sub-Sahara. We've seen that post-famine that prices of food remains high, and so does stocks remain low. What kinds of interventions do you think are necessary by the host government, maybe IMF, to mitigate this situation?
Should we take a couple? Yes. Tim? And then Patrick.
Hi, thank you for your comments today. Tim Docking, formerly with IBM Corporation, and in that light I was very interested in your fintech comments and the importance of technology in Africa going forward. Three quick questions, I think, or perhaps big questions, but I think you can address them if you can prognosticate a little bit. It's sort of impressive to hear a conversation about commodities in Africa without any discussion of China and the impact that China has had on commodity prices in Africa. How do you see China's relationship specifically to the commodity markets in Africa going forward? Will they continue to be as important as they historically have been, or do we see demand from other areas? In the area of preferences, were briefly discussed, but at IBM, we saw a lot of local content issues arising, affecting foreign direct investment, not just in IBM, but in the tech industry. How do you see that in the future impacting FDI, local preferences? And finally, regional markets is another area that we haven't really talked upon. They've been slow to develop, extraordinarily important. I think everyone would agree to Africa's economic future, and I just wonder if you could say a few words about that. Thank you.
Okay.
One more, or that was kind of a couple?
Yeah, let me.
Okay, let's go start there.
So I don't forget, and I can
Yeah.
do justice to the. So on famine and what can be done. I think we're not. We don't directly work on humanitarian outbreaks like this. So I'm not sure that I'm the best placed person to answer this. Of course, when countries ask for our support, and there's a difficulty of any kind, either natural disaster or simple drought, we always try and be as helpful as we can and provide balance of payment support and financing to the government. But the specific interventions that are needed in the area of alleviating food insecurity, I'm not really well equipped to try and answer that. All I can say is that what we've seen across the region is that incidences of food insecurity, I think, have declined, and this decline has been associated with overall progress and development that has taken place. So the fundamental answer, of course, is always through more investment in rural roads and agriculture, finding ways of reducing the wedge between farm gate prices and market prices. But this is a longer development challenge. The immediate interventions in the wake of droughts I think tend to vary. What we do is support the central government in providing resources. On the impact of China on commodity prices, I think China is just such a huge and global player that I don't know that there's an impact which is separate to Africa to that in the rest of the world. I say this in the following way, that we've seen places like Brazil, Australia being impacted as much as Nigeria or Zambia by the developments in commodity prices globally. Yeah? So China is just the appetite in China is over the last 10, 15 years for commodities has just been so huge that it's the whole global commodity price, and of course, in most cases, it's integrated, that it's been impacting. Where maybe there's an Africa-specific impact is the extent of, where to the extent the FDI declines or the investments they've been making in commodity sector to the extent that attenuates. We haven't really seen that in a big way. So, how it plays going forward, we don't know. Of course, to the extent the Chinese economy is going to be going through this structural reforms that they're pursuing and be less commodity intense, that will have a bearing on the strong commodity exporters in the region. But then again, we are seeing economic growth in other, in Europe and in other countries and even in EMs beginning to pick up, and so that may offset some of the decline in demand from China. So I think we just have to look at global commodity prices. One thing our in-house projections show is commodity prices staying at their current level and not really rebounding back to the levels they were a few years ago. So I think that message has been internalized also by most countries in the region. On local content rules, I think I'm again, not the most qualified person to speak to this, so if you don't mind, I'll skip. But on regional markets, I do think that this is one of the big challenges for the region and a very, very important source of growth, a growth pole for the region. Unfortunately, we still don't have enough roads running from between countries in the region. So, if you go to Niamey, really the main route out is to Burkina and Nigeria, and not to next door to Mali, to Bamako. And that interconnection within the region really, continues to be a huge deficit, and one which increasingly more priority, I think, countries have to pay to. One big challenge, just as in within countries, you have one of the reasons why you have variation in prices, why there isn't enough growth, is because you're having incomplete markets. That's true of the region as a whole. So the more we are able to have better roads that connect countries, the more you're able to complete markets and trade more with each other and engender greater economic activity. So I just want to recognize that.
Patrick, and then the lady next to you. Yes.
Patrick Ukata, American University. I share your optimism about the demographic trends within the continent. And my question, though, to you is, what is your institution and maybe your sister institution, the World Bank, doing to focus on the education aspect of all of this, in terms of maybe specific recommendations on beefing up the institutions of higher learning, for instance, to better prepare the population for these kinds of global net export of well-qualified and trained Africans?
And then there's yes, right on the aisle there, yes.
Hello, Ajani Husbands, U.S. Department of State. I'm curious to hear your thoughts on the third prong of the priority responses that you mentioned, particularly investing in social safety nets, social protections. And I'd like to hear your thoughts on strategies for financing these. In particular, given that it seems that some of the reason that we've reached this point is that you have sort of increased high levels of spending from some countries despite decline in income via lowering commodity prices and so forth. So I'd like to know, sort of, is there a varying strategy from depending on the type of country, whether it's an oil exporter or non-commodity country, or just are there any other sort of thoughts you might have on how to finance this approach?
And the lady, the aisle.
Good morning. Thank you for your presentation. My name is Howie, Georgetown University. I have two questions. The first is regarding kind of the current Trump administration and the large cuts that have been made, particularly for development aid in Africa. And how might you kind of evaluate this? Is this encouraging more capital inflow or outflow? Is this an opportunity for kind of more organic economic growth? My second question deals with the relationship evaluated between democratic transitions and sustained economic growth. In places like Ethiopia, we see large GDP growth, but at the same time, we see economic growth really concentrated among a minority ethnic elite. So how might you see, I guess, the IMF playing a role in a more fair distribution of resources? Thank you.
So I think the first two questions on social safety net are related. So I'll try and address them: education and the social safety net. So on education, of course, we deal in macroeconomic policies and don't really have any expertise on education policy per se. But where it features in our program is, in general, spending on health, education. Tends to be protected, or we consider that in most countries, particularly low-income and developing countries, as where we have programs as priority spending areas. So we, of course, in general dialogue, discussion, wherever we see education attainment levels being low, school enrollment ratios being inadequate, particularly in those countries where we see enrollment rates for girls being weak. This is something which we point to and have a dialogue with authorities, but we don't, and what we say is and look is for ways to protect spending in those areas to try, to the extent that is the reason why we're seeing difficulties. But we're not really experts on education policy, so we don't go delve into the details on that. But I think one of the things, as I said earlier, that have underpinned the strong growth that we've seen and the strong development outcomes that we've seen has been, more emphasis, more focus in spending on health and education by countries over the last many years. So there's absolutely no doubt why, of the importance of continuing to invest, particularly with the demographic dividend that is playing out, the demographic transition that's playing out in most countries. On social safety nets, we've done a bit of work to try and look at what kind of social protection programs are in the region. And the picture is really, really varied. In many countries, they tend to, where there are kind of specific programs to mitigate vulnerable groups, they tend, they play some role, but they tend to be very small and not well targeted. Most countries, I think, are at a level of development where you don't have, what you see in the West of, either, social security type programs which cut across the board. Those, other than South Africa, they really don't exist. And, probably balance sheets and governments' balance sheets probably are not strong enough to be able to afford that. So what we are working on, and particularly in those cases where we're seeing a big decline in growth, pressures on incomes, is to try and identify ways, the quickest way is to try and identify existing programs to try and expand those. In programs where, in the countries where we have programs, we try and focus on that. And where we don't have programs, we work closely with the World Bank, other donor agencies on the ground to try and see new programs that can be introduced as quickly as possible to try and mitigate the impact. But, so I think the overall picture is a very mixed one. So some countries have these programs, they're not well targeted. In other countries, they don't exist. So the challenge is to come up with new programs. But I want to also make one point, which is that, in terms of how to finance this, it's always going to be a challenge for this. But one thing that we continue to highlight is, there are quite a lot of countries where you have very regressive spending. A good example is fuel subsidies. You have some countries where there are very generous fuel subsidies. By and large, the benefits of this tend to accrue to richer households. So, rather than poorer households. So in those countries where we have explicit, policy understandings to remove those, for example, we always make a point to introduce new social programs to try and mitigate the impact of that removal on poorer segments of society who also, of course, stand to benefit. So, in a nutshell, that's the kind of work we've been doing. On U.S. administration aid policy towards aid, I think we have yet, we've seen in pronouncements, but we have yet to see explicit policies laid out. So it's difficult to say much about it at this juncture. And on the question on Ethiopia, I'm being from there, I have to recuse myself from answering questions on that. So that's my response.
Let's, yes, the gentleman in the back, and then Ms. Holly. Yep.
Hello, thanks for your presentation. My name is Yinka Adiguke. I'm the Africa editor for Quartz. I was interested in the almost throwaway remark you made about a meeting with the Nigerian government, and they were looking to the East for inspiration. And I presume you're referring to Ethiopia in that comment. And I wanted to understand what they could learn about slightly a more central control of the financing from Ethiopia.
there was one more. Oh, yes, up here.
Thank you again for your presentation. I was just curious, I'm interested in, of course, the demographic issues you mentioned, and also that the threat of climate change across the Sahel, the issue of migration, and for the role of remittances from abroad and the effect on the economies.
Okay.
Yeah.
So on Nigeria, I think the Minister of Finance in particular, I think explicitly had come out and said that they were looking to Ethiopia, particularly on infrastructure investment and how to do big projects, and that's the context in which the dialogue that I had came up. So I think particularly on that side, I think Nigeria is looking to not just Ethiopia but also other countries like Kenya, the recent railroad that's been built there, to try and see if there's anything that they can glean from how to do infrastructure investments very quickly, to have some early wins, particularly in that area. On climate change, I mean, and in the Sahel in particular, I was in Niamey a couple of weeks ago, about 10 days ago, and it's just a city which is already very hot, and of course facing all kinds of pressures from including most recently the security threat that they face from all around. Has to deal with this longer term challenge of climate change and how to integrate that and pay for that. Frankly, this is not an issue which is fully in our domain, but something which worries us because of the long-term implication for growth, for spending that the government is going to have to do to try and defray the impact that that's going to have on agriculture, on the production of energy and sources. So we look at it more from the macroeconomic impact that it's having. What is clear is that places like Niger, Burkina, and other countries in proper Sahel are going to have to invest a tremendous amount going forward. The Minister of Education was pointing out to me that each year they have to hire about 10,000 teachers to keep the school enrollment levels at 100%. So on top of the demands that they have on the budget from these social spending pressures, if they have to invest a lot more in mitigation measures, the challenge is, you can imagine, going to be really quite acute. So if there's one region, one area where I think you have a mix of these macro challenges, macroeconomic policy challenges, together with slower moving variables like demographics and climate change, it is that whole Sahel belt, and I think addressing that is going to be important. On migration, I think my understanding is it's not so much that those countries are the source of migration, but you have a lot of people traveling through there to try and reach the Europe coast. Part of it, I think, has to do with demographics, but I'm not sure you can draw a simplistic line to demographic pressures being the main source of migration. I think it's general low level of income relative to Europe. Of course, from time to time when you have economic shocks which drive down growth, that becomes a source of pressure, people leaving in search of better opportunities. But as I said, many countries are still early in the demographic transition phase, and I'm not sure other than the fact that you have a lot of unemployed people, and I think it's the main thing. The main gap really is the big divergence in income levels between the region and Europe, and why it's all the more important to have higher growth and more investment in the region to get economic activity going.
On the remittance question,
Yeah,
is that something that the IMF looks at, and new vehicles and different kinds of consumption, investment?
So, it is, what we are seeing is, it is a very important source of financing for some countries, particularly with countries with very large diaspora abroad. But we don't, it's one of the flows in the balance of payments, a bit like export receipts. That comes in, and it's very important. What's good about remittances, of course, is that it goes to, it goes directly to the people that are using it, and it's one which is not, and it's also fairly stable, unlike portfolio type flows. This hot money that comes in and has also a tendency to leave quickly.
Dissipate. Maybe one of the things that we're trying to look at are there different vehicles through which higher income diaspora populations might kind of pool and invest and
send more money.
Rather than kind of invest in, or send money to pay school fees, invest in the school system, or rather than health fees, invest in. But I'm not sure if that's really come to fruition, and that may not be your
maybe a prejudice of mine, but
you like
I think I think it's in the nature of these flows that they are responding to some kind of demand, and I think the less we get government mediation in all these flows, the better.
I don't know how we are at time. Let's take one there, and I have a general question.
Thank you very much. I'm Andy Joe from Princeton University. I wanted to ask, of course, every economist's favorite question, which is about political feasibility. It seems to me that the recommendations that you're making, particularly on structural reforms to address fiscal deficits, which sounds like they're going to involve increasing the extractive capacity of the state to take advantage of returns on public investment, that's going to be a contentious issue for sure. Anytime you want to extract things from a national economy. And then on the third point about social protections, if you're trying to expand that, that's going to be contentious. How are you going to distribute those benefits? Who's going to get more? Who's going to get less? So, how optimistic are you? Do you have a read on that about whether these countries actually will politically feasibly, will be able to fix their roofs before the sun stops shining?
Good question. So,
maybe I could just piggyback on that, because then step back, because we're going to be closing in on time, is you've been away from Africa for some time. You came away from Africa within the IMF, but you've had a long career there. You went away, and now you've kind of come back in more recent years. And I'm wondering, has the traction of the IMF, have you seen changes in the attitude? There's lots of different competing models and advisors and development banks out there. There's the Rwanda, Singapore model. There's the Washington consensus, whatever that status is right now. And so dovetailing to that, these politically difficult questions and trade-offs, the IMF has, it's had its controversies in Africa. And I'm just wondering, as you answer that question, maybe you can step back and think a little bit about the IMF within Africa writ large, and how it's received, and how its relative kind of stature and traction compared to this. Maybe too big a question, but I'll throw it in the hopper there.
Okay. So on the first question about what kind of political support there is for some of the difficult reforms that I think are necessary in countries. It varies from place to place again. But one thing we've seen, particularly on something like domestic revenue mobilization, is there's been a lot of progress over the last 10, 15 years. So I think we've seen an increase of around 2.5 to, it depends, but about 3-4 percentage points in GDP, in tax revenue to GDP levels relative to where they were in the mid-90s. So with this growth, there's been an increase. Again, to varying degrees. Some places it's been very difficult to get that up. But one thing that's clear is that to have a state that's going to be providing the basics. That we're talking about health, decent level of health, education, and importantly, increasingly, there's become evident that there's a big infrastructure deficit in the region. Lots of traffic jams across the region, electricity shortages. So governments have been seen it in their own interest to try and collect more money because you cannot continue to rely on deficit financing because of the debt implications. So there is a meeting of minds on how to do it. We offer a lot of technical advice on how it can be done. So IMF does a tremendous amount of work on for example, how to have a tax administration that is efficient, that will segment the taxpayers into different sections and find where you're losing a lot of money or where there's a lot of potential to collect. And we identify also kind of gaps and potentials countries can aspire to. And what that work generally shows is that countries can aspire to collecting, again on average, around 0.5 percentage points of GDP in tax per year. But of course, as you said, tax collection is very much at the heart of the social contract, right? So the more the government is able to demonstrate that it's making good use of the money, the more that's going to be easier to collect. And of course, there's also political decisions that have to be made on who to tax. So, depending on the strength of the government, so it varies from country to country. But in terms of needing, the resources that are needed to address the country's development objectives, countries will have a trade-off. You either find a way of paying for this through taxes, or you're going to have to cut spending. So I think countries are beginning to grapple with that. Just the other thing I want to say is, in the region, there hasn't been as much use of things like toll roads and other user fees for infrastructure projects in particular. You still tend to see electricity being priced inappropriately. So there is some scope to pay for specific investment projects using also, appropriate pricing of tariffs for water, for electricity, at least for the segments of society that can afford to pay full price while still trying to subsidize poorer people. So there is some work that can still be done to try and collect, not just through the tax channel, but also getting user fees up to some extent. So difficult challenge, very much in the political domain, we recognize, but ultimately, something which countries are going to have to grapple with and where we're seeing progress. On your broader question about the fund's engagement in Sub-Saharan Africa, I have to say that, we continue, we have, I think almost with every country, fairly warm and cordial engagement. And from time to time, of course, depending on circumstances, difficulties, we see an increase in the number of programs, which is the case at the moment. We in almost all countries, we're seen as a trusted advisor in terms of particularly macroeconomic policy discussions. So we have very close dialogue with all with governments. Where countries want us to be engaged even more, of course, we have more intense collaboration, so program engagement, and not always programs involving difficult trade-offs, but in places like Tanzania, Uganda, Senegal, we have something called a policy support instrument. So in those cases, these are strong growing countries, generally mature stabilizers, we call them, strong macroeconomic policy frameworks that have been doing well. And our policies, basically, our dialogue helps, we're like, they help, we help bounce ideas of each other and also try and be as supportive as we can on policy framework with no money disbursement. Of course, one thing, as I noted earlier, we've had very difficult engagements in the past in Africa, in the 80s and 90s in particular. That also reflected the very difficult circumstances, the very difficult policy environment, the very difficult political environment also. But I would say that by and large, with governments which are more democratic, more open. The dialogue over the last 15, 20 years really has been positive. As our managing director likes to say, kind of, this is not your grandfather's IMF. So we've changed also.
Not your grandfather's Africa either.
Exactly. So we've changed. We've learned a lot from the experience of the past on what works and what doesn't work. But the circumstances on the ground, as you said, are also very different. So in general, I think very positive engagement.
I do get the sense that growth is kind of ratcheting up with better policies, better institutions, and there are frequent setbacks, but on the whole, the trends tend to be going in the right direction, if very slower much than many would like. Listen, thank you so much. It's very kind of you.
Thank you.